All right, welcome everybody. Wall Street Jesus here. Tuesday post-market webinar. I'm going to start off. It's going to be a brief one today. I don't think there's too much to cover. Some important things, no doubt. But I think we need to spend the majority of time on the overall market and the setup we got in our lap now as we're heading into the Fed. After that, we have a trade war decision from the Donald. So, headline risk is definitely up there. And let's see. Okay, let's go back here and talk a little bit. Again, I find you always got to go back, know where you came from to help figure out where we might be headed. And if you remember, all right, we had this drop and we came to the conclusion based off of sentiment readings and a lot of the positioning stuff we look at, that there was enough damage to bullish positioning and sentiment of this pull, this drawdown, that at the least, okay, even if this market has intentions of heading south, that they would chop them up, right? So the conclusion, again, this is all, we're going over what we already spoke about, but it helps put all the pieces together to where we are now. All right, so almost to a T what we were expecting. If you take away the noise, the inverted yield curve headlines, Trump and his tweets, and all the gyrations and volatility and movement, okay, this is exactly what we thought was the highest probability of what might take place, okay? And again, it's not because we have a crystal ball in our back pocket or anything of that sort. It was just because this drawdown bit bulls enough in the rear end and got bears revved up enough to the point where the likelihood of this thing just going south right from that point wasn't likely, because they would have had to pay a lot of riffraff bears positioned for that move, okay? The amount of crash protection and hedging that took place off this pull was ridiculous, right? And we saw that again in all those sentiment readings we look at. That's what they were telling us. So when you see that, the likelihood is, okay, that the market's going to wear out the public money positioned that way before it makes that move lower, if it decides to do so. All right. We also mentioned that there was some risk to the upside, not necessarily new highs, right? We were talking about, to the higher end of the range, there'd be the second favorable scenario would have been, a little more upside out of the chop, right? So a little bullish tint to the chop. And the reason being, everybody who puked up their long positions into this, once the market settled down a bit and some of that fear came out of the market, and you get a market start to push higher and volatility die down, you get that unwind of all that positioning. All right, so in simple English, everybody who was positioned and protecting for a crash, once they realize the crash doesn't happen, they have to unwind those positions, and that's what can possibly help and assist a bullish bias, even though it's, consolidation in a sense. All right. And, that's what the question was for me coming into this week. You're not going to go to new highs and break through. No, there were no signs of that happening before the Fed, obviously. All right. But could we get up, maybe into this area through some tough resistance into the Fed? You know, and that's what we thought there was a possibility of maybe happening early this week. You know, the possibility is still there, right? I think you have Draghi. I don't know, is he tomorrow? But you have a couple of days, you know, with the Fed minutes and then Powell speaking on Friday, that there is a chance that, you know, we push a little bit higher off this setup. All right. But net for me, for like as far as game plan is concerned here, okay, I don't think anything that we were looking for and planning for coming into this changes. Okay. I still think the best long entries are going to be off, you know, sell-offs where you have sentiment line up and get on your side, right? So you have a higher probability of a squeeze or a snapback, right? I still think, you know, the lower end of the range for now is probably your best risk reward out there. And you know, it's early yet. It's early in this setup where we don't have enough evidence of anything, you know, larger than that taking place. Eventually, you know, the market is going to make up its mind and, you know, either come down and test these lows and possibly break through it, or some, you know, some sort of uptrend forms out of here with, you know, higher lows and higher highs. And we're going to see that, in my opinion, we're going to see that in the flow, you know, as that uptrend takes place, as it comes into fruition, right? As we see it on a day-to-day basis, we're going to start to see, you know, sweepers position for, you know, upside in a good amount of names. All right. And like I said, it's too early for that. There's been some encouraging signs. Like yesterday, we saw some decent flow, meaning that, you know, there were other names that bulls were willing to put some money behind. A lot of them were under the hood type names, meaning, you know, not high beta names, kind of on the DL type names. But again, you don't want to jump to conclusions because it's too early, and you want to take a day by day approach. You want to see what the flow, you know, brings to us on a day to day basis, and when there's enough evidence where we can have some confidence, regardless of whether we think possibly a new uptrend or there's not much buying at all, and they're at least going to come down and test these lows, there'll be further evidence of one of the two scenarios. Okay, so you don't want to try to get in the game of prediction when there's no edge, you know, to make that prediction. I mean, my gut, right, based off, again, just experience in how a lot of these things play out, we are really close, as you've heard me talk about ad nauseum throughout this whole process because I want it so bad, but we're really close to some of those intermediate term sentiment signals, signals that usually flash at major bottoms. Okay, we're close enough that we have the possibility of getting that entry spot. Okay, it doesn't necessarily mean price action. It doesn't mean there has to be a leg lower out of this for us to get it. If this market chops around like it's been doing, and we even go down to in the neighborhood of the lower end of this range with the Fed, with Trump, and all the negativity out there, you know, economically, fundamentally, the inverted yield curve, you name it, that it's not going to take much to get there. It's not going to take much at all to get there. And that would be the ideal scenario through my point of view. Okay, that I don't mind we dance around. I don't mind there's some selling and, you know, we end up at the lower end of the range. But at the end of the day, we get some of those intermediate term signals that, you know, sometimes you don't see bullish signals fire off in years. at the least months, bearishness gets to the point where some of those signals are flashing buy signals, and then we can get serious about looking for some, like for example, some of the flow that has some time behind it and names you like off a pull. That's the ideal entry point. So I don't know, any name, like let's say an Amazon, I'm just using examples, right? You have a little more weakness there, and you've been dying for an entry in Amazon, but you never had the pull to find a decent risk reward there. If we happen to see flow come in for late this year or January, February, that would be ideal when you have intermediate term sentiment signals going off. Why? Because the likelihood is the downside should be limited, not just in price action, but in time. Because those signals generally are telling us that the likelihood is the selling has been exhausted. And that's usually where the smart money comes in and buys things. Okay, so that's the beauty of those intermediate term signals, flashing bullish signs. Because a lot of the flow, even if it's selective too, like even if they're buying two names on a day into weakness, right now we probably ignore it, right? Because we can sit in a drawdown and sit underwater for a bit of time, and who wants to do that? So when you have those intermediate signals, or you even really close to having those intermediate signals on your side, that's when you can really start to, average into a position, buy into weakness, buy a little here, buy a little there, that sort of thing. So that's what I'm hoping for, and we're not too far away. And this rally has done nothing to take away from those intermediate term signals if you're worrying about that. They've hardly budged off this rally. Yeah, that's really good. Okay. Because again, there's a lot, as you guys know, there's a lot of negativity out there. There's not a lot of, good signs out there, right? You got the trade war, looks hopeless. The Fed looks stubborn here, where, clearly the market's telling them they're behind the curve. The economies all over the world are crackling and crumbling around us. So the longer this market sits here and sort of chops around and you get those noisy down days, the quicker, people start getting more and more bearish. Almost the opposite of when we're at highs, right? What happens? The market sort of hangs out up here and really is not, flying through levels, but sort of in a melt up grind mode. And the bullishness just right? Stems up and continues to heat up over the course of time that it's up here. And then the move comes, So that's kind of the opposite of what we're looking for. And hopefully, we get there sooner than later. The one scenario that would be a bad scenario, I guess, for us in the long run would be if we do get some sort of uptrend here and it basically shakes out all that bearishness that we got involved here. That's certainly a possibility. So you kind of get more of the same, what we're seeing now, just like we mentioned, with an upward bias, right? But because there's been stability for a good amount of time, all of a sudden now you got more bears who don't want to miss the boat of a rally, right? Or more bulls who puked out into these lows that don't want to miss a rally. They get back in. Bears who are short looking for that new leg lower get shaken out. And then you have the risk of, something that can easily happen into September, which is seasonally the perfect time for a move lower, So we'll see. That's why, again, we don't want to get too caught up in creating a bias or a prediction and sticking to that right now because we don't have enough evidence, or an edge, I guess is the better way to say it, to really have much of a bias with any confidence behind it. Yeah, so McElliott, Charlie McElliott from Numora, who basically looks at positioning. The other dude is Kalanovich from JP Morgan. Basically, they were looking at the same stuff, that all the positioning that was all into the highs really took down their exposure into this pull, right? You had a lot of crash protection and hedging put on, and all of that needed to unwind. And you have the same thing, like we were saying, a risk for more upside here if this market continues to be stable through the Fed, and then you got the Trump tariffs. Here's the two big things, okay? And you hate these event type things, but they're important. If you didn't have the Fed, right, the whole gamma game, if you didn't have the Fed and you didn't have that Trump tariff deadline in September, you really can make the case that you got a legitimate low here, and on dips, you could get a little aggressive as far as swing trades are concerned, okay? But because you have two big things, fundamental things to the economy taking place, all right, and they're in the process of wearing out that crowded bear position, there's more risk. You know what I mean? Because let's say we go into the Fed now, okay? We go into the Fed and Powell completely drops the ball, right? And we're trading like right along these lines. You can definitely see some legitimate selling pressure come in. And it's not like, sentiment where it was here, right? They've softened it a bit, right? There's not as much bearishness out there. So that's the risk now. That's the risk, that you have the Fed, and then even after that, the tariffs, which may be even a bigger deal. They may be even a bigger deal. If Trump goes through with those tariffs, that next tranche of tariffs, that's a fundamental shift to the economy, and you may have a lot of that positioning stuff, like those quants and all those guys, look to take down their exposure, right? Because you'll have bonds doing their thing. You'll likely have more volatility comes in. It's almost a snowball effect. When you have these events, it can get the ball rolling. It's a trigger. Dead, I think you might be the only one who lost audio. I don't see anybody else talking about losing audio. Everybody else is okay with audio? Yeah, everybody else is okay. All right. Anybody have any questions? So in simple English, me personally, I'm not doing much into the Fed. I'm not looking to hold much through the Fed at all. And we'll see what the market looks like, what sentiment looks like, what flow looks like post-Fed. Things could look a lot different, right? Could be put sweepers, grab the ball, and you have some decent momentum to the downside, and you don't want to be caught long into that, right? Or the opposite. Maybe Powell, it's going to be hard because they're expecting a lot out of Powell, but maybe Powell does the right thing, the market likes it, and they start to get really aggressive in some stuff out there. And I'll tell you what, guys, and we've been talking about this for a while, I don't see any healthy rally stemming up unless the stuff that can't hold green for the life of them starts to catch some real bids. You know what I mean? All that tariff stuff, all that trade war, the cyclical stuff, they can't keep buying shop, Samir. You know what I mean? They can't keep buying shop. They can't be buying the software names hand over fist, and that's it. it's just not going to last. It's not going to last. So you can get squeezes, you can get, a short little uptrend out of it. But for another leg higher, like an uptrend higher out of this, it's going to have to be that quote unquote reflation trade that's been so out of favor for a long time now. I don't see any other way a healthy rally from here can, there can be any steam behind it. It's possible, though. It's definitely possible. The logic behind it is that the Fed cooperates, we avoid a recession, and the economy starts to turn around with all this stimulus being thrown around out there. It's not just the Fed. You got Draghi ready to do whatever he can muster at this point, right? You got China, they're starting to stimulate. So if it actually works and gets animal spirits going again to the point where you avoid a recession, kind of 2016. That's the 2016 playbook all over again. Same exact thing. All right. So here we are again. This is the 2016 setup again. Exactly like this. Exactly like this. It's scary how close to the 2016 setup we're in right now. Maybe not price action so much, but just like where everything lines up going in. Yeah, Mike Wilson's talking about a drop to 2,700. 2,700. Yep. Yeah, he's not looking crash. Tree, you know what I mean? He's not looking crash. He's looking for, just a normal correction. And his logic is the only reason he's looking for a correction and not a crash is because a lot of this stuff has been at play for a while. Everyone's like, oh, this market, has been a raging bull for so long and needs to crash. That's not what's been going on. Literally for a year, we've been doing this, you know what I mean? And gone nowhere. You know what I mean? So it's not like this market has gone parabolic. Very similar. I don't know if you guys remember trading 2015, 2016, but it was very similar where things just, very select handful of names really did well. And you had a whole bunch of nothing for a good year. Some wide ranges. Yeah, and the logic tree, the good thing, the way to look at it, like you're saying the entry, okay, if you remember like that 2016 low, that you're not going to get much better of a sweet spot than that. That was the Bazooka Jolo, if you guys remember, where, we weren't seeing impressive flow for a good amount of time. And then all of a sudden, right, everybody and their mother was bearish. Oil was tanking. Everything was a disaster. And then all of a sudden, we started seeing, huge sweeps come in just when you would least expect it. Yes, it came at a perfect technical spot. They weren't chasing green. It came into intermediate term bullish sentiment, literally like clockwork. So all the things lined up, and maybe they can line up, the same way now. That would be a beautiful thing, but we'll see. Listen, me, I get the label perma bull, okay? But when even myself, when I don't have enough evidence like I do right now, you have to consider that, the market may need another leg lower. It's very possible. Yeah, the 2016 low was one of my favorite bottoms ever. One of my favorite bottoms ever. Because you know what it was, like 2009 was a major low, but everybody was pooping their bloomers, and it was so hard to get involved. It was so hard to get involved. You had bigger things on your mind than your options account at that time. 2016, I remember like it was yesterday. Everybody was so bearish that there were bullish signals right in front of you, and people were just ignoring it because of their bias. So all you had to do was have your eyes open, and you saw it play out right in front of your face. Yeah, it's like the New Testament. Exactly. Yeah, that's right. That's right. You had Bernanke going in to Jackson Hole. You're right. So there's a lot of similarities. And hopefully it plays out that way. I'll tell you what, if that reflation trade, and again, we've been talking about it a while, so there's no proof or anything like that it's near, but if that reflation trade ever does come to fruition here, you're talking about a major rally, guys. You're talking about a ridiculous rally. We haven't seen a rally, even the rally off the December low, I don't think would do it justice if they really get behind some of these cyclical names. I'm not just talking about short covering. So, the semis catch fire, all the good things that don't look like this, basically. Okay? All the good things that don't have a chart like this really start to heat up and see crazy buying, where you don't have to chase another new high to find some momentum. Things are carving out bottoms, and you just see them popping off bottom bases, and a whole new uptrend out of that. It's a beautiful thing. Yeah, this win been looking good. There's a lot of things that look okay out there. Don't get me wrong, there's a lot of ugliness out there, but there's a lot of stuff that looks okay out there. I mean, even some of the semis, which you would think would be getting beat up, look okay, right? Like Micron and all these names. So, yeah, AMD, a lot of them, right? Even NVIDIA had some life. That was one of the dead ones. But look at Texas Instrument. You wouldn't even know we were in a correction, and this is like Texas Instrument was in the heart of that trade war, right? You remember this thing too in December crashing. This is a blue chip of blue chips here, and it's looking healthy. It's looking healthy. So maybe these semis are kind of giving us a heads up on how things may play out. Again, wishful thinking here. It could all change in the snap of a finger. But listen, if Powell doesn't play ball, like, is it possible? I don't think so. But if Powell comes out with a stubborn hawkish view, you could see the market getting really pissed off and giving them the business. So that's what creates a problem here. Otherwise, if you don't have those things in the way, you can look for entries on dips on all these things that have been seeing action and look healthy. All these things. Yeah, you got to take it one day at a time. You have no choice. If let's say we get a squeezometer signal and a short-term trader sentiment signal going into the Fed, you want to roll the dice on some SPY calls. That's fine. I'm talking about you don't want to get too aggressive and stick out your neck here and get caught. There's no reason for it. There's no reason for it. And that's the point I'm trying to make. The majority of the swing stuff I've been doing, as you guys know, is when we get short-term sentiment bullish signal. I find some stuff to buy, mostly SPY QQQ, and I look for a squeeze and I sell it. That's what I've been doing for the most part. And that's what I'm saying, where the playbook stays the same. I'm going to continue to do that until we get some further evidence and get through some of this noise. and we'll see the flow wake up once we get through this. What, either bullish or bearish, we're going to see them play with more confidence. You see, like today, you have to ignore today's action, in my opinion. It was ridiculous, cheap, really cheap stuff that never even catches weekly activity was catching cheap weekly plays. There was a lot of hedging going on. So, you don't want to make too much out of those days. You don't want to make too much out of those days. And, you hear me say this, like a broken record. The buying that comes into the weakness is usually, where the true colors come out. That's where you get your answers. So in other words, like where we're at now, all right, let's say after the Fed, there's some selling, right, down to here. If you got sweepers getting aggressive into that, that's an extremely bullish sign, extremely bullish. I don't care how negative and bearish people are coming out of that Fed. If you got, if you have one of those days where they're sweeping SPY calls all day long, right? $500,000, $1 million sweeps like we were seeing into the last low, you have to take that serious. A lot more serious than if we were up and you're seeing SPY calls, because, that's all that unwind of the protection we've been talking about. But into weakness, that's where real buyers are sticking out their neck. Yeah, you had a lot of things on it. You had a lot of things line up off this low here to get long some stuff, for a trade. And it worked out nicely, So now you're going to take it easy. You can't treat this point up here the same way as you did down here. You had potential wind at your back there, You don't have that juice up here. You don't have, right, you had some flow to confirm it, right? The TQQQ guys. Yep, VXX call rider. You had some flow to confirm it, right? Not cheap garbage like we're seeing now. So that's basically, I can only share what I'm doing. And as of right now, the way things are right now, that's my play. I'm looking for another setup like this for swings. Everything else is going to be intraday stuff that I'm looking to maybe grind it out and hopefully make a little money, until we get some further evidence. Anybody have any other questions, and then we'll dive into some names that maybe you guys are watching that maybe caught a little action and looking for further action in. Anybody have any questions at all? Now is the time to ask, especially if you guys or gals are members. You have to ask these questions here regarding, a sentiment indicator that you're unsure about, or, the playbook. You don't want to play this game blind. Okay, we got some questions here. What's the difference between the total put to call, equity put? Okay, pretty simple, Ron. The total put to call is a measure of option volume, both put and call volume, not buyers. Okay, just general volume on everything, the total is. Where the equity just measures the volume, puts and calls in equities. All right, so for me, over my experience, the equity tells you a cleaner story, in my opinion. Okay, because sometimes even the bullish of scenarios, you get protection in ETF and in the indices. Equities, you really get a good measure of, at extremes, of fear and where greed may be taking part. A perfect example, okay? That was another thing, Ani, if you remember, into this low with everything you said, and Yosti, everything you said, you had an equity put the call almost flash a 1. I think it was a 9-8. That's panic. That's a panic reading. The last one was into the December lows. All late last year, when the markets rolled over in October, we didn't even get close to a 1 on the equity put to call until that December bottom. That's a panic reading. So that goes to show you, you know, how much fear went into this thing. You know, so that's the difference. And you know, we have certain levels we look for, especially on the panic side. You know, anything, it depends on the market, but you know, anything near a 1 is panic, period. So if you ever see that, that's a good spot to start leaning bullish. And if you're in an uptrend, you know, normal pullbacks like these, you know, a lot of times anything with a 7 handle or above could be bought for a trade when you're in an uptrend. So that's on the equity put to call. What's the famous CTA model that gets quoted so often? Gamma exposure, so what it means. So yeah, Matthias, it gets complicated. I suggest if you really want to learn about it, you can Google it. There's a lot of information on it now, because not only the popularity of it, but because it's really important, like it really moves markets, okay? But the logic behind it and what we're looking at is just positioning, all right? So what happens is if everybody up here, right, is positioned max long, so their long exposure is basically as much as they could possibly have, okay? Any trigger and some selling, you're gonna have all these outfits taking down their exposure. You know what I mean? So when you see you're up at, you know, highs and you see, you know, max long exposure on these quants and, you know, all that stuff we look at, the risk is to the downside. The market can continue to float around and grind higher, but any little trigger that creates selling and things can snowball to the downside like this because all those positions have to unwind, okay? And what we saw on the flip side, not only did they unwind, okay, but as the market continued to sell, now you had them stretched on the other side, okay? So that meant any trigger for upside, and you get these big squeezes. You see how not only the size of them, but you see the magnitude of the squeezes we see these days, right? How quick and how powerful they just go up in a straight line like this, boom, boom, right? They make it up like that. That's all stems from that stuff. There's a good Wall Street Journal article. I posted on private Twitter. I'll post it on my regular Twitter that talks about this and how it's been playing a big part in markets. All right, so that's it. In simple English, like if you Google the term gamma exposure, it's directional risk. That's what it pretty much measures. You know, and like, for example, like McElliott, who basically, you know, you have smoke out of your ears when you read them because it could get so complicated. But you get used to it after a while. I got used to it. I know a couple of you guys got used to it. It takes time, but you'll get used to McElliott. You know, he's building a lot of credibility because that's all he looks at in regards to the market. He's not your traditional analyst looking at charts or looking at fundamentals or any of that stuff. He basically developed a model to try to get a better read on the positioning out there. And, you know, when they're at extremes, he looks for triggers that can set up a big move to the other side. So like the logic is, right, the simple way to play it, when you have gamma exposure, right, at an extreme into lows, the logic is you buy out of the money calls, okay? Because that's where you're going to get your biggest move, your biggest bang for your buck in a short amount of time span when and if it turns. You understand? So that's the simple logic behind it. And like I said, if you want, you guys, you could Google it. There's so much information on it. So much information out there. Ron was saying, how is the current SPY bear flag wedge pattern? You got me there. I have no idea. You lost me already with the SPY bear flag wedge pattern. I'm not a pattern dude. I don't know if you know Tim. I would recommend Tim Option Trader in the room if you remember. He's more on the technical side than I am. I'm just strictly sentiment and sweeper activity. I don't really look at patterns too much. You know what I mean? Yeah, and don't ask me about moon phases. We got another guy, Tim, for that. We're all set up, you know? The current chop, yeah, so, you know, I explained it at the beginning of the webinar. You know, technicals aside, the chop makes sense just based off what we were seeing coming out of, you know, the sentiment in itself and positioning. And another thing we haven't mentioned yet, I think we should mention every freaking webinar because that's how bad they've been, the hedge funds, right? I mean, it's incredible. They were all in with everybody else. So now you had quants, you had some riffraff, you had hedge funds, you had them all finally get long up here. And then they got caught. And lo and behold, the hedge funds puked up a lot of their long exposure into this downdraft. You know? So it all played its part into what we're seeing now. And now this, you know, there's no guarantees in this market, as you guys know, but that's why we were saying the higher odds of something like this, that was the highest probability. Something of this taking place, all right, because this happened so quick. You know, you had a lot of bearish positioning and crash protection needing to unwind. And, right, the VIX was at play. You had a bump in the VIX. And basically, this is what you get, you know, from my experience when something of this magnitude happens so quick like this. You know, it wasn't that this was that big of a move. It was the velocity behind it. You know, it was the velocity behind it. So, and that's why I tell you guys, no matter how bearish of a scenario or a setup you guys are going to present to me, whether it's technicals or fundamentals, it's not that I'm disagreeing with you. I'm just saying that when sentiment reaches an extreme, the market may be heading lower. You may be right, but they're going to wear out those shorts before they do it. They're not going to pay everybody who got in here on the short side. You know, you think all these guys that get short here looking for the end of the world are going to get paid? They never get paid. You know, market makes it look like they're going to get paid, right? Oh, here we go. Rally right back down to the lows, break right through them, and run over again. Eventually, there's enough wear and tear that a good amount of those bears get worn out. They give up. And then if the market needs to take another leg south, it will. You know, that's the logic behind it. It's not me being a perma bull or any of that nonsense that some of you bears think I'm promoting. You know, and you know, a lot of times you guys like present a fundamental case to me. And you know, the reason why I give it a shrug is because, you know, the fundamental case that you're talking about, everybody knows. You know, everybody's talking about. One mistake you're going to make is that you think you're smarter than the market and anybody else. There's no information you're going to gather on your own through your research that's going to outsmart the market. The sooner you come to that realization, the better off you are. I kid you not. The sooner you look in the mirror and admit in this game that you're an idiot, and no matter how much you know means nothing, the better off you are. Right, unless, you know, you got that Trump connection and he's giving you the wink, right? He's giving you the wink. But it's the truth. It's the truth. You know, sometimes it comes across as simple, but there's a reason why people say when you're buying, when everyone's bearish and everyone's on one side of the boat looking for a move, if you have the ability to take that other side and you got the coconuts to be aggressive doing it, you can make a lot of money in this game. And you're a rare bird. I tell you, my issue has always been the coconuts. I'm being straight with you guys. You know, I'm being straight with you guys. A lot of times I treat it with kid gloves. You know, I want to take it nice and easy going in. You know, I don't. But if you can be a cowboy, right, at the right times, you know what I'm talking about, Joey, right? That's a rare combination to have in this game. And that's, you know, that's what the big boys have, man. You hear about Drunkenmiller all the time, right? You know, the guys like that, that's what they have. That not a lot of people have. It's not getting all bulled up when everyone's bullish or all bared up when everyone's bearish and suicidal and negative out there. You're not making much money in this game doing that. Yeah, exactly. I can't do it, Ani. You know, but it's the truth. All right. Anyway, so that's the scenario here. Just one more thing to add before we call it a wrap. I don't have much as far as names that I'm even excited about yet. That's another thing I'm a little negged out about. And maybe, you know, maybe it's a sign in itself, but there's nothing, you know, there hasn't been action that really has got me coming in, like I mentioned to you guys, coming in the morning and saying, you know what, I got to try to buy some of this with some time. You know, usually in corrective phases, I end up building a decent list of names, you know, that I want to watch into weakness and want to start buying. Whether I buy them or not, it's a whole other story, you know, but there's usually a good amount of names that I'm saying, all right, they continue to come back for this thing. You know, this thing's not doing a thing price action wise. The market's weighing on it, but they keep coming back. They're legging in, they're rolling down. There's not much out there. You know, the names that have caught action like that, I mean, I can't buy them anymore. You know, like this ENPH, which is, yeah, an under the radar type play, but this is what they look like, a lot of these names. I'm talking about like even big names, right? A Caterpillar, where maybe they're sizing into and positioning into off a niner down here, right? It's not doing nothing. It's not doing a thing, but we're seeing $500,000 bull sweeps come in. You know, that's what I'm talking about. That's the type of action that I'm talking about, right? The Bazooka Joe moments, all that, that's the type of action. They're not coming into stocks that are already hot. They're coming into these things dead and buried where nobody's even looking at them. Nobody even wants them. You know, so usually I have, and it's early, right? I mean, the correction just started in the sense, if it turns into any legitimate correction, who knows, you know, a bigger one, a larger one. But out of corrections, I usually have a good amount of names. If you remember December, you had a ton of names that were difficult to buy because they weren't doing a thing off action. But you had names like PayPal, SE, QSR, Yelp. I mean, I had a watch list full of names that were catching size sweeps into the mess. No, I mean, Tesla, you know, we saw a sweep of Tesla the first day of action down here, but, you know, it wasn't anything. It was a September normal little sweep, you know, for a trade. I'm talking about hammering stuff. I'm not talking about just one bet either. You guys know what I'm talking about. We went over this, I think, the last webinar. PayPal had to catch probably 10 sweeps throughout this whole entire thing. Remember that, right? Brown, how many sweeps did PayPal catch during the holidays that time. You know, and the stock, because of the market, the stock couldn't do anything. You know, it was just up and down, up and down, up and down. And then, you understand? So that's what I want to see. I want to see them hitting names that are stuck, that aren't seeing a reaction off the flow. Most people ignore it, right? If they're acting poorly, most people are ignoring the flow. But that's what you want to look for out of corrections, because then when the market finally finds its footing, this is what happens. You know, not all the time, but some of the better action, this is what happens, right? QSR, I actually own that out of that whole thing here, right here too. They started buying it. There were a few of us who owned this, and stock continued lower as they were buying it. Zero reaction, you know, and then look what happened. All with time behind it. SE, you guys know by now. We've been talking about this. SE was down today off earnings too. But SE, a name that never catches action, they were tattooing down there. So, you know, that's the type of stuff. There was a Benzinger article about the 142 calls on Microsoft being bearish bets. What do you mean bearish bets? They were rolls. Is that what you mean by bearish, Abby? I don't know if you caught the open interest and some of the commentary. Actually, no, they weren't selling them. They were buying them. They were rolling up from. Hold on, I'll find it for you right now. How do I find it? Let me try this. Here are the OI changes. All right, so you could see how many traded. There was like, I think 90 or 100,000. 32,000 of them stuck. They had a nice move. So you would think a lot of them got flipped. And you see here, they were closing out some other weeklies they bought a couple days prior. You know, again, guys, it's important. You'll get away with it in bullish, all-out bull markets, but you got to understand, for swing trades, day trade, you're just looking to get in the middle of things, right? But with swing trades, you got to understand that you want to catch the action when it first stems up, okay? So you see here how they're hitting the 140s, right? They got aggressive coming with the 140s here, okay? The next day, if the stock runs, and then the next day the stock is running, and now you see the 142 calls getting bought, that doesn't mean these guys are putting on new bull bets as the stock is $3 higher. They're rolling up. So in other words, the initial position, the 140s, they close those and they move them up to the 142s. You know what I mean? You guys know what I'm talking about. Where is this? This is the 15th. See this Microsoft action? Like, look at all these weeklies they were hitting here. All that action gets rolled up. They don't continue to put new money to work on the way up. They roll. So if Microsoft has another move, they pocket some money and they still have exposure, you know? But you want, basically the goal is, okay, off a pull, if Microsoft starts catching action here, here's the entry for a swing. You want to own it right here, okay? If you don't buy it here, you don't want to buy it up here now. You know, you missed the entry. When you first start seeing them buy it off a pull, that's where you want to own it. Because the likelihood is the rest is just rolling activity. Maybe not all of it, but definitely included in the flow is rolling activity. You know? So that's what you're looking for swings. Now, day trading, you know, you hear me, that's basically my bread and butter for day trading. For day trading, You just want to get in the middle of the flow and, use the momentum. That's what you're looking for. All right. But always the biggest moves start from the initial activity, the initial point off a pull where a name sees action. That's what you want to look for. There's a lot more risk. Listen, Microsoft, you got away with it a lot chasing, but you got to understand you're chasing here. You're chasing. You can't expect this move to happen again here. Plus, you need the market in this environment to do that. You're going to need the market to help you out. But that's the logic. I know it's hard to resist. Listen, this is always the toughest spot to pull the trigger. Always. That's how you know this is the best spot to pull the trigger. This is always the toughest point to pull the trigger. Why? Because they're selling, everyone's bearish, and the flow, you're like, oh, all right, you can't get gassed up on it. But now when the stock starts moving, right, you're like, oh shit, I missed that entry. You know what? It looks so bullish. I got to buy it here. And now if Microsoft goes into a little breather here, you're talking to yourself. So, but you can't, one cardinal rule you hear me talk about all the time, you can play all you want, right? I'm not here to tell anybody what not to play, what to play. But one thing you can't get in the habit of doing is weighing the action here, putting as much weight in the action that comes in here, and putting the same weight in the action that comes in up here. You can't do it. It's a losing situation in the long run. So if you have to play the chase, you can't, you're a degenerate, your juices are flowing, you have to play it. Whatever size you would take at the sweet spot entry, at least chop it down dramatically up here. That's the only thing I can recommend. No, Tree, I wish. Caterpillar hasn't caught a $500,000 sweep in ages. I'm saying that's what Caterpillar would catch if they really wanted to own it. I remember Caterpillar at prior lows in the past would catch a $500,000 sweeps when we would get excited. It hasn't caught any, no. That's what I miss. That's what I need. That's what we're missing here. That's what we're missing. Right. Anything different, Tim, anything different. Like, you look at like some of the names that we've seen sweeps in, right? Like Team caught a good looking bet, that's all fine and dandy, but this is not the wise guys showing confidence in the overall market. Like, look at this. Now, how much money has been made in Team already? That could be a prior sweeper. If you guys remember, the last decent Team sweep was earlier in the year. It could be that same dude saying, you know what? I made a killing on this thing. I'm going to buy some over here off a tiny pullback. That's not somebody sticking out their neck, calling a bottom in the market. So that's been the difference. The names that are catching, that continue to catch the better looking action, are names that have been littered. Microsoft, Team. There's been so many bulls in these names. So many. I even mentioned like Sony, right? Sony's been one of the few. I can't, what does it tell me? They started the initial activity, the good looking activity started literally into the lows. That's the type of action I'm talking about. That was out off the last pullback, by the way, if you remember. Okay, the last pullback we had. That's where the action, and guess what, right? Not a lot of people could have played Sony off of that. I know a few of us did, but not a lot of people are going to get junked up at Sony down here. Now it's continuing to see action up here. But it's not somebody sticking out their neck. If we see somebody come in to Caterpillar and lay into it like they, what I mean? Like they did in Team and that stuff, and you see those type of names in bunches start to catch buying like that, then you know something may be cooking as far as the market as a whole. Then similar to 2016, whoever was around watching the flow with me, out of the not only 2016, out of the election too, out of the Trump election. Off the Trump election. So the flow hasn't been anything spectacular. We had some nice flow the last rally off the December lows, if you remember. But, for a while now, the flow hasn't been anything spectacular. Like Tim is looking for a BKNG. How long has it been, Tim, honestly? Since I think the last BKNG bet was a put seller, wasn't it? I could be mistaken. I don't know why I remember that. Is that possible? Was it a put seller? See, so like option trader Tim in the room is talking about a sweep in BKNG. This thing never catches action. If you see action in this name, it's something special going on. What's my thought on everybody throwing out the 10-year correction? What do you mean the 10-year correction? Brown, what are you talking about? Every 10 years a correction? I don't know. I think we're in a correction right now. Brown, maybe there's some blood to come. Let me tell you, Brown, all kidding aside, and I'm a bull at heart, okay? Some of the most vicious corrections, okay, started off like this. You get a vicious drawdown, too many bears involved, you chop up, sometimes you even test highs. I remember 2007, it tested the highs. And then, kaboom. So I'm not throwing up any possibilities out the window. That's why I'm telling you, right? I spent the majority of time in this webinar telling you that right now, from what I'm seeing, my playbook is not changing. I'm looking for squeeze trades when bears get too riled up and I can get that snapback squeeze, but I'm not sticking my neck out building a portfolio off this dip. By no means. You know what I mean? By no means. Cause of the risk of that, without a doubt. If we see bearish sentiment reach an extreme that we usually see at major bottoms, and then you see the flow start to turn, then I'll be singing a different tune. Then I'll be singing a different tune. Because I know from my experience, no matter how scary it may look, usually when everybody's positioned for it, the opposite happens. December was no joke, right, Tree? That was legit. That correction was legit. Especially that the time it came around, like during the holidays, right? The fear was like nobody was around. The market may break. But the key is the key is if you're a swing trader, there's no reason to get involved, right? When you're seeing that take place, right, and there's nothing exciting you out of the flow, there's no reason to, get yourself hurt. Wait. Wait. There's always a better setup for you in the not too distant future. Sometimes they take a little longer than you would like, right? What to do? October through December, the last major correction everyone's talking about. But if you kept your eyes open and you stayed involved, we were talking about that continuously, and you were around for the turn, there was a lot of money to be made there. So it was worth your wait. Yeah. If you're a new trader, Brown saying cash is a position for newbies. There's no doubt about it. If you're on the newer side of trading, right? If you're trading just a couple years and you haven't already found success shorting the market, my best advice to you would be to remain in cash and wait for that setup, and there'll be easier times ahead. Because, don't get me into one of my short rants. You see what's going on to shorts right now, how difficult it is. You see what they're putting them through right here. Like, charts don't even do it justice looking at a chart. Like, when you're short and you're sitting through this, you couldn't get out of the way of, or this, this little move off that low feels like this when you're short. It takes a lot of experience to sit through it. But yeah, I mean, I agree. Right now, this is, from what I see that with everything, this is what I see. We're still downtrend. I don't see any clues that we're coming out of this yet. Nothing yet. So we'll see how it plays out. Anybody have any final things to add before I let you go enjoy your dinner and your night? We're all good. If anybody's new here, wallstreetjesus.com. If it all sounds foreign to you, you could go. I'm going to probably look to add some stuff on here too. Some of the newer stuff we talk about. But if you go to the strategy section, some of the basic stuff, you can read up on, quick reads too. All right, from sweepers to all that stuff. And if you're interested, we offer a 3 free-day trial, no credit card. You could get it off the site. Also, private Twitter, you go to products and you go to private Twitter and you could get private Twitter. All right, but private Twitter is included in the premium membership. So it's all one. Yeah, I know. I got to take my daughter was hounding me all day here today, looking to get out of here. I try to teach her about the market a little bit. She has as much interest in the market as I do politics. No interest. No interest, even if I bribe her. All right, guys, have a good night, and we'll see. We got Jackson Hole in the Fed minutes and all that jazz later in the week. We'll see how we'll look. We'll go over at the Saturday webinar. We'll see what we got. Have a good night, everybody.